Think about what makes a community really, truly thrive. Families, businesses, growth. But what if there's something invisible holding it back? Like a line drawn on a map that stops people getting home loans just because of where they live. That's basically redlining. And today we're doing a deep dive into a pretty significant Justice Department settlement about this. It happened recently, right in Miami.
Yeah, it's a practice that's supposed to be illegal, long gone, but it keeps showing up. So just to be clear for everyone listening, redlining is when lenders, well, they avoid giving credit, like mortgages, to people in certain neighborhoods, usually communities of color.
Hmm.
And it's based purely on the race or national origin of the folks living there. It's absolutely unlawful discrimination.
Right. And our mission here is to really unpack this specific Miami case involving a mortgage company. We want to look at what it actually means for the people in those neighborhoods and why this settlement might be a signal of something bigger in financial regulation. It hits real people hard. Understanding this stuff is, well, it's crucial.
Okay, so let's get into it. The company's called the Mortgage Firm, Inc., and the Justice Department's complaint basically accused them of a pattern or practice of lending discrimination, specifically redlining, against predominantly Black and Hispanic neighborhoods right there in the Miami-Fort Lauderdale, West Palm Beach area. They call it the Miami MSA.
Okay, a pattern or practice. That sounds serious. What laws were they actually accused of breaking? What was the legal hook here?
The core of it was violations of two major federal laws,
Hmm.
the Fair Housing Act and the Equal Credit Opportunity Act, EQOA. These laws are fundamental. They exist specifically to prevent this kind of discrimination in housing and credit. So the alleged actions by the mortgage firm were seen as, directly violating the spirit and letter of those laws.
So how did they supposedly do it? What were the specific actions or maybe inactions that added up to redlining in this case?
Well, the complaint detailed several things. First, just failing to provide the same access to mortgage services in majority Black and Hispanic areas compared to other areas. But it wasn't just about not being there. It's also alleged they actively discouraged people in those communities who are looking for credit, sort of steering in the way or making it harder.
Wow. Okay. So not just neglect, but actively putting up barriers, potentially.
That's what the complaint suggests, yes. And other things pointed to this too, like where their offices were located mostly in predominantly white neighborhoods. And critically, the DOJ said they took inadequate steps. That's the phrase used to market their loans or build relationships, referral networks within the Black and Hispanic communities.
Right. So you put all that together, physical absence, maybe discouraging inquiries, not marketing. The outcome seems pretty predictable.
Exactly. And the result, according to the complaint, was that the mortgage firm got far fewer mortgage applications from people in predominantly Black and Hispanic neighborhoods in Miami compared to their competitors, to peer lenders. That big difference in application numbers, that was a key piece of evidence suggesting discriminatory practices.
Okay, so we see the allegations, how it supposedly worked. Let's talk impact. What does this actually mean for people, for communities? What's the Justice Department's take on the real-world consequences?
It's huge. Assistant Attorney General Kristen Clark put it very plainly. She said this kind of practice doesn't just violate the law, it denies entire communities equal access to credit. And, crucially, it makes the racial wealth gap worse. Homeownership is still a primary way families build wealth, So if you block access to that, you're hindering not just one family, but the economic health of a whole neighborhood. It affects everything: schools, local businesses, investment. It's systemic.
It really is. It's like this hidden drag on economic mobility. And, you often think of redlining maybe in the context of big old traditional banks. But the DOJ seems to be making a point here that this applies to everyone in the lending business.
That's absolutely right. And U.S. Attorney Mackenzie LaPointe down in Florida, he stressed that point. He said lending discrimination, sadly, persists in this country.
Yeah.
And that the commitment to fight it covers all types of lenders. Banks, yeah, but also credit unions, and very specifically, mortgage companies like this one, non-depository lenders.
Right. So the goal isn't just slapping a fine on them. It sounds like it's also about fixing the problem going forward, providing that expanded access to home ownership you mentioned.
Exactly. Remediation is key. Which brings us to the settlement details. What did the mortgage firm actually agree to do? First, there's the money, $1.75 million. But it's not just a penalty paid to the government.
Okay, so where does that money go?
It's specifically for a loan subsidy program. It's designed to make loans more affordable for people buying homes, refinancing, or even doing home improvements, but specifically in those predominantly Black and Hispanic neighborhoods in the Miami area that were allegedly redlined.
How does that work in practice? Like, what does a subsidy mean for a borrower?
It can mean several things, maybe a lower interest rate than they'd otherwise get, or perhaps help with a down payment, which is a huge barrier for many. It could also cover closing costs, or even the initial mortgage insurance premiums. The goal is to directly lower the financial hurdles for people in those specific communities.
That sounds like it could make a real difference for individual families. But what about the company itself? Are they required to change how they operate to prevent this from happening again?
Oh, absolutely. That's a huge part of the settlement. They have to conduct what's called a community credit needs assessment. Basically, they need to go out and figure out what the actual credit needs are in these neighborhoods. And then, this is important, use those findings to shape their future loan products, their marketing, their outreach. They also have to do a deep dive and assessment of their own internal fair lending program within Miami, like an internal audit focused on fairness.
Okay, so listen to the community, then look hard internally. Makes sense. What else?
They need to beef up their fair lending training for all relevant staff and ensure they have proper staffing dedicated to this, including maintaining a specific position, a director of community lending. This embeds fair lending into their structure, hopefully for the long term.
And what about getting the word out? You mentioned lack of marketing was an issue. Are they changing that?
Yes, very concretely. They are required to maintain a physical office in a majority Black and Hispanic neighborhood in Miami-Dade County. They also have to translate their website into Spanish. Makes sense for Miami, right? And all their loan officers working in the Miami area now have a mandate to actively market to majority Black and Hispanic neighborhoods. No more just waiting for applications to maybe trickle in.
Wow, that is a significant shift from the alleged behavior. It sounds like they have to actively engage now.
They do. And there's more on the engagement front. They need to build better community ties and referral sources. How? By holding 4 community outreach events each year, offering 6 financial education seminars annually, and partnering up with local community organizations. It's all aimed at rebuilding trust and making sure people in these communities know about and can access credit opportunities.
Okay, that's a pretty thorough set of requirements. So zooming out a bit, how does this one case fit into the bigger picture? What's this Combating Redlining Initiative the DOJ keeps mentioning?
It shows this wasn't just a one-off investigation. This settlement is actually the 16th one under this broader initiative. And significantly, it's the 3rd one specifically targeting a non-depository institution, like the mortgage firm.
That term, again, non-depository. Why is that distinction so important right now?
It's absolutely critical because these non-depository lenders, the ones that aren't traditional banks, they don't take deposits like checking accounts. They now actually originate the majority of mortgages in the entire country.
Wait, the majority? More than traditional banks?
Yes, that's a huge shift in the market over recent years. So if you're serious about tackling lending discrimination today, you have to focus on these non-bank mortgage companies. Otherwise, you're missing where most of the lending activity and potentially most of the discrimination is actually happening.
Okay, that really puts it in perspective. So the regulators are clearly adapting to where the market has shifted.
It seems so.
Yeah.
And the overall impact of the initiative, when you look at all 16 settlements, is pretty substantial. The DOJ says they've secured over $153 million in direct relief for communities of color impacted by redlining across these cases. And they estimate that this relief money is expected to spur over $1 billion in new investment into these underserved communities. That's a massive potential impact.
$1 billion in potential investment? That's incredible. And this specific mortgage firm investigation, did it start within the DOJ or did it come from somewhere else?
That's interesting, too. It actually started with a referral. It came from the Consumer Financial Protection Bureau, the CFPB, which really highlights how different government agencies are collaborating on this, sharing information, working together to catch these practices.
So wrapping this up, our deep dive really shows that redlining isn't some dusty history lesson, is it? It's still happening. And it shows regulators are having to play catch up in a way with how the financial world has changed, especially with these non-bank lenders becoming so dominant.
That's exactly right. It's a present-day fight.
Yeah.
It requires constant vigilance, not just from regulators, but from the lenders themselves and, from communities demanding fairness.
Which leads perfectly into a final thought for you, our listeners. How can we, as community members, as individuals, play a role in making sure everyone has fair access to things like home loans? And what responsibility do we have as consumers to demand transparency and accountability from all kinds of lenders, the banks and the non-banks, especially as this landscape keeps changing? And just a reminder, if you think you or someone you know might have faced lending discrimination, the Justice Department does have resources. There's a housing discrimination tip line, 1-833-591-0291. You can also report issues online through the DOJ website.